Good morning students, myself Bhavish Bhakchandani. Today we are going to discuss about one of the topic of accounts. You will be getting all the information about accounts, and of that we are going to discuss at present chapter number 6 of part 2. The name of chapter is cash flow statement. Cash flow statement itself indicates that how much cash we are getting in our business and how much cash is going out from the business. That statement is called a cash flow statement. We are very much aware that in business so many types of receipts are received. For example, when goods are sold, money is received. When investment has been made, so somewhat interest or dividend is received. If we are issuing some shares, for those shares money is received by us. Whenever company issues a shares, company is going to receive that money. All these are the types of receipts that a business is getting. In the same way, business is also paying so many expenses, so many payments have been made. For example, salary is paid to the employees. When goods are purchased, amount is paid by the business to the creditors. When the debentures are matured, company is supposed to pay back amount to the debenture holders. That is called redemption of debentures. In the same way, many times company also pays back money to the preference shareholders. Mainly these three are the investors who are investing money in our business, and after a certain period of time we are supposed to pay back money to them. Out of that, money will be paid on the priority basis to the preference shareholder as well as to the debenture holders. Equity shareholders will not be getting money back during the existence of a company. At the end of company, when company is liquidated, at that time equity shareholders will be paid their money. So all these are the examples of getting money, that is cash inflow, and paying money, that is called cash outflow. In business, when we are talking about companies, all the companies which are registered under the Companies Act 1956 or an amended Act 2013 are supposed to prepare a statement called cash flow statement. For this cash flow statement, company has to prepare this statement and divide all the activities into three types. Now we are going to the core part of the chapter. All the activities of business will be divided into three parts. First will be operating activities, second will be investing activities, and last will be financing activities. Whenever we are receiving money, that is called cash inflow, and whenever we are paying money, that is called cash outflow. The net difference of cash inflow and cash outflow, we are talking about net difference, means when we deduct cash outflow from cash inflow, we get net cash flow in the business. From our business point of view, we are supposed to bifurcate all the incomes and expenses in three heads. First head is operating activity, second head is investing activity, and third head is a financing activity. Now, what type of transactions are taken in operating activity? All the transactions which generate income of a business. Repeating, all the transactions which generate income of business, means when goods are sold or when salary is paid to the employees, all these are the transactions which are included in operating activities. Second head is investing activity. In investing activity, all the transactions related to assets, we are talking about assets, will be included. Many times business is selling assets and business is purchasing assets. We all are aware, when we sell our asset, we will get money, that is cash. So that will be recorded in a cash inflow. When we are selling goods, we receive money, so that we will be recording in cash inflow. In the same way, when we purchase our asset, if we purchase any asset, for example land, building, machinery, furniture, stock, when we purchase, we are supposed to pay money. So at that time cash will go out of business, so that will be recorded in a cash outflow. When we receive money, that will be recorded in cash inflow, and when we pay money, that will be recorded in cash outflow. Only in terms of asset, all the assets will be recorded in the investing activity. Last activity is a financing activity. Financing activity means from where business is getting money. For their business, we have to issue certain shares. When we issue shares, we get money. That is called cash inflow. So in a brief, we can say that whenever shares are issued by the company, money will be, that is capital, will be received by the company. So that will be recorded in cash inflow. In the same way, if we pay dividend to the shareholders, dividend will be paid by the company to the shareholders, like equity shareholders and preference shareholders. So when we pay dividend to the equity shareholders and preference shareholders, that will be recorded in cash outflow, because we are paying the money. In the same way, when debentures are redeemed by the company, again that will be recorded in a cash outflow. If we are redeeming bank loan, redeem means to pay back, when we are paying back bank loan, that again will be recorded in a cash outflow. And last, that is interest. When interest is paid to bank loan or to the debenture holders, again that will be recorded in cash outflow. In the same way, the net difference of cash inflow and cash outflow will be called as net cash flow from the financing activity. In the same way as in investing activity, the difference of inflow and outflow will be called net cash flow from the investing activity. And in the same way, operating activity, the difference of inflow and outflow will be recorded as a net cash flow from operating activity. The total of all these activities will be called total cash flow from our business. So you all might be clear that all the activities are divided into three parts, that is operating activity, investing activity and financing activity. Okay, you all might be clear with this. Thank you.